Hi, I'm Kenton, and this is Kenton Knows. Just the other day, Cody Gordon commented on my duplex investment video asking me to do a video on flipping properties and the tax ramifications to the profits. So I sat down and put this together. I hope you like it. What is real estate flipping? Real estate flipping is fairly simple in theory. Buy an underpriced or undervalued property, improve it, and resell it at a higher price for a profit. Sounds fairly simple, and there seem to be a lot of TV shows that show complete amateurs supposedly making money doing it, so it can't be too hard, right? Well, let's dive into the details. Assumptions. For this video, we are going to assume we purchase a property for $150,000. There is not an HOA. Property taxes are $1,500 per year, and we make $20,000 in improvements. The renovation takes 3 months, and then we list the property for sale, and the new buyer closes in 2 months after listing, so the holding period is a total of 5 months. We will assume we put 20% down for the purchase, and we get a loan at 5%. If the renovation or sale take longer, you borrow more money or borrow at a higher rate, all of these changes will simply increase your carrying costs. In this situation, you will need to have about $60,000 available to complete this deal, but I would advise you to have a little more of a cushion in case you run into any trouble along the way. For many of the costs, I will be using averages, which may vary from state to state, and I've provided a link in the description below with the source for these averages. I will also summarize all the line items I used and the percentages in the description so you can refer to or copy the line items to use for the analysis of your own flips. For simplicity, I will also round all numbers to whole dollars. Why flipping sounds great. When you see a TV show or hear about someone flipping a house on social media, it sounds like easy money, right? In this video, we'll use the assumptions I have described and compare selling the house for $250,000 and $200,000. Both sound fine on the surface. Buy the house for $150,000 plus $20,000 in renovations means we're into the house for $170,000. If we sell for $250,000, the profit is $80,000. Or if we sell for $200,000, we still make $30,000. Both seem perfectly reasonable. So let's actually dive into the real numbers for these two options and see what you think by the end of the video. Buying. We'll start with the buying process. We are assuming your time and effort is not a cost in this example, but we should acknowledge that the time you spend doing this flip is taking away from other activities you could be doing. So there really is a cost to your work. Hopefully, the profit makes it worthwhile. When you buy a property, you won't need to pay a commission as the seller is paying it, which is great, but you do have other costs. The upfront costs while under contract and before closing are earnest money. We'll use 2% of the purchase price, or $3,000 in this case. Inspection fee, $400, and appraisal fee, $400. The total upfront costs are $3,800. Closing costs. Typically, your closing costs should be between 2 and 5% of the purchase price. For this example, we will use 3.5%, or $5,250. This is in addition to the down payment of $30,000, but you'll only need $27,000 at closing since you already provided $3,000 in earnest money. You will also need an insurance policy, and you probably want a slightly higher policy if you will be renovating the property, as there is a higher likelihood that someone may get hurt or damage the property during the work. Let's say this would be $1,000 per year. You'll need to pay it upfront, but the unused months will be refunded when you cancel the policy upon selling the property. Total purchase costs. Purchase price, $150,000. Appraisal and inspection, $800. Closing costs, $5,250. Insurance, $1,000. Since this is for the year, you'll get a refund of the unused portion when the property is sold. Total purchase price, $157,050. With $30,000 down payment, the mortgage is for $120,000. Monthly carrying costs. While you own a property, you have carrying costs just for owning it. And the longer you own the property, the faster these monthly costs will reduce your potential profit. For this property, your monthly carrying costs will be as follows. Mortgage, $644. Approximately $145 per month goes towards your principal. Utilities, $150, which includes gas, electricity, water, sewer, and garbage. I'm assuming no internet, no phone, cable, HOA fees, lawn care, or snow removal. Property taxes, $125 per month. This property has a total carry of $919 per month, but you will get $145 back per month as it's paying down your mortgage principal each month. Renovation costs. Keep track of the miles you drive and all the material you purchase for the renovation work. All of your expenses will be added to your purchase price to increase your basis and decrease the taxes you'll pay on your profit. This includes tools that you will keep after the project is complete. In this example, we are spending a total of $20,000 on the renovation, including all labor, materials, tools, etc. Remember, time is important as every extra month reduces your profit. Selling costs. When it comes to selling the property, these costs can be more than you may expect. Time is of the essence at this point, as you need to sell the property before your carry costs eat away at your profit. Normally, this means you list the property slightly below market to get a quick sale. Assuming you are using a real estate agent to get maximum exposure, you'll be paying at least 5%, but it may be a 6% commission in your area for this price range. I'll use 5% for this example. If you stage the property, it will probably cost at least $1,500. The closing costs for the seller are about 3% plus the sales commission and staging. Before taxes. Here are the total numbers before taxes. Sale price, $250,000. Carry cost for 5 months, $919 times 5 equals $4,595. Staging costs, $1,500. Realtor commission, $12,500. Closing costs on the sale, $7,500. Refund on prepaid insurance, 7/12 of $1,000 or $583. Total received from the sale, $224,488 minus $120,000 loan plus $725 you paid towards the mortgage principal, so you'll walk away from the closing with $105,213. Wow, but oh wait, we also put down $30,000 and we invested $20,000 in the renovation, so our net profit is actually $55,213. Not bad for 5 months worth of work. Oh, but wait, we also have income taxes. Income taxes. Even if you only flip a house or two per year, you will most likely be considered a dealer, and you will be taxed at ordinary income rates, depending on your yearly income. If you are married and filing jointly, and your income is between $80,251 and $171,050, then you would be taxed at your ordinary income rate of 22% for any income over $80,251. Plus, you'll be subject to a self-employment tax of 15.3% on your profit. If you are lucky enough to not be classified as a dealer, everything is the same except you don't have to pay the self-employment tax. We are starting with a net profit of $55,213. I have already taken out all of the closing costs, interest expenses, commissions, and property taxes. Next, we deduct the following. Let's say we drove a total of 100 miles at 57.5 cents per mile, that's $58. Let's say you deduct a home office expense or some office supplies at $100. Let's say you use an accountant to prepare your taxes and you write off a portion of that expense, we'll use $500. Let's say you set up an LLC for this project. So conservatively, we'll say you spent $1,000. So net profit after these deductions, $53,555. Federal taxes at 22% of $53,555 is $11,782. Self-employment tax at 15.3% of the $53,555 is $8,194. Now state taxes, they're all over the board. We'll use an average rate of 3%, and that will be an additional $1,607 in taxes. So your total gain after all taxes is $31,972. As the sale price changes, so do the closing costs, as they are based on a percentage of the sale price. If the sale price went down to $200,000, the numbers are as follows. Sale price, $200,000. Carrying cost, $4,595. Staging, $1,500. Realtor commission, $10,000. Closing costs, $6,000. Prepaid interest, which is an extra $583 that you get back. Total received from the sale is $178,488 minus your $120,000 loan plus the $725 you paid to your principal is $59,213. Now we subtract the $30,000 down payment, $20,000 in renovation costs, brings the total profit down to $9,213. If you use the same deductions of $1,658, then the net profit before taxes is $7,555. Total state, federal, and self-employment taxes at the same rates as above would be another $3,045. So the net profit after taxes would be $4,510. The point is that if you buy a property for $150,000 and spend $20,000 to renovate it and then sell it for $200,000 in only 5 months, you only make about $4,500. And if you sell it for $250,000, your net profit is about $32,000. If your renovation takes longer or you use hard money with higher interest rates, your carry costs will be substantially higher. And if the property takes longer to sell or it sells for less than your target price, you may actually lose money. So you need to be extremely careful when you're doing a flip. Summary. Let's summarize this from where we started. You buy a property for $150,000. You add in $20,000 for renovation, sell it for $200,000. You think you're going to get a $30,000 profit, but it's actually only $4,500. Or if you sell it for $250,000, thinking you're going to get a profit of $80,000, but it actually ends up being only $32,000. My flipping opinion. Flipping can be lucrative, but it is a lot of work. There is a lot of risk and a significant chance of things going wrong, the market changing, or the property not selling quickly for your target price. Any of these can significantly eat into your profits, but the real culprit here is the high cost of real estate transactions and taxes. In my opinion, the best markets for flips are ones where there is a low inventory, prices are rising fairly quickly, and you can find an undervalued property. The way I see this working better is if you can reduce the transaction costs, which means you either need to be a realtor or know you can sell the property without one. But be careful, as properties that are sold by owner can sit on the market a little longer than one listed by an agent. Unfortunately, there isn't a way to really reduce your tax burden unless you hold the property longer than a year, which really isn't a flip anymore, or use other losses to offset your profit, but that means you aren't making any money anyway. Other options. You should also consider the other options you have to invest your $57,000. Consider keeping the property, renting it out, and refinancing it after 6 months. You'll save on the transaction costs, but you can still hopefully pull some of your investment back out. Or you could have invested the $57,000 in a broad market ETF or REIT with less risk and very little work. I'm not saying which option is better or worse, and there is risk in all of these situations. I'm just saying you should compare your expected return and the risks associated with your options before making the best decision for you. I hope this video gave you a better understanding of the costs associated with flipping real estate to help decide if this is something you might want to do. If you like this video, please consider subscribing to my channel and clicking the bell. Please like the video, leave a comment, and be sure to check out my other videos as well. Thank you for watching Kenton Knows.